Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And a welcome. This is the second hour of the Investor Coaching Show. I'm Paul Winkler. Talk money, investing. So as I was watching TV this week, it's just interesting to me because there are areas of the market that I've talked an awful lot about and said, hey, be super, super careful, folks. Investment portfolios are overweighted in these market segments, and they've been overweighted for quite a while, in some of these areas of the market that, big companies, large companies, growth companies, and technology companies, those types of things. And you just don't know when that's going to come crumbling back down. You just don't know when that's going to come crumbling back down. And we've been seeing some of that recently. We've been seeing it come down just simply because of what's happening over in Iran. In areas that have been overlooked for a while have been holding value so far this year. And who knows? You just don't know what's going to happen, where things are going to go. This is why you diversify. But there are market segments that are up, over 5%, so far this year, where the S&P is down almost 7%. So you just go, that's why we diversify. You just don't know what's going to happen. But it's always entertaining watching the financial channels and hearing people talk about how people are managing their portfolios. And this is the topic of conversation earlier this week. And I just thought I'd use it as just a little bit of an educational tool here. Just check this out.
Again, all right, I'm just curious. You're an investor. You've been taking risk off. Today, do you feel like you're all clear, or do you really have to wait?
Now, what does that mean? You've been taking risk off. You're an investor. And I would put that in quotations. You're a market timer. You're taking risk off. If you're pulling money out, and this is what happens behind the scenes so often with investment portfolios, people don't even realize it's happening. For years, what I would do is I would actually take very, very popular mutual funds, and I would just announce here on the show, hey, here's the cash holdings in this fund. And this is what, you have 10% of the portfolio sitting in cash right now in this mutual fund. It's a stock mutual fund. It's a mutual fund investing in stocks. 10% of it's in cash. You go, well, no big deal. Well, it is a big deal because the market goes up. You got 10% of the portfolio is not going up with it. That is a big deal. And then the other thing, on the other side, you say, well, why do they have 10% of the money in cash? Well, they could be market timing. Probably are. Well, why would they do that? Is because they think maybe that the market's going to go down, so they're holding a lot of cash. Well, the question you have to ask is this: why don't you put all of it in cash if you really think it's going to go down? Why would you even hold anything in stocks at all? Because they're not that confident in their guess that it's going to go down, is the answer. But anyway, he's saying, risk off for now. And that's the point.
Clear, or do you really have to wait and kind of see? Obviously, first of all, we don't know what the outcome of these potential talks, if they are actually taking place, will be. And so the prospect of re-engaging on this threat to bomb the infrastructure of the country in terms of its ability to produce electricity remains. The Strait of Hormuz.
And of course, that got put off again. But he's saying you don't really know, and you can hear the hesitancy in his voice. And that's the problem. What the market's going to do is highly dependent upon all of this. And the problem is you just don't know. Yet people were going risk off. They were pulling money out of the market. If you have a result that is favorable, markets will go up and they will skyrocket, and you will have missed it. That's the problem.
I don't believe has seen any
and that's
uptick in traffic.
Test, right? I mean, if a ship could go through 5 days from now, then I think that you'd say, wow, there were talks. The United States clearly has a victory to declare.
Well, it's also the possibility that this thing ends. I mean,
Right. And that's it. You just don't know. And then all of a sudden you're sitting on the sidelines and it's gone up like that. And, so to me, that's the problem you run into. You look at these types of talks and conversations about what you should be doing right now. And the reality is most people think, well, I'm not doing anything. And they don't recognize that the investment manager may be doing things. How do I know that this is happening? Look in your prospectuses. Look at your documents that talk about what your investment advisor can do. And I often will point this out to people. They'll bring their stuff in. I'll say, bring your stuff in, bring your investments, bring your investment documents in, your management agreements, those types of things, your ADVs. And if they don't have the ADV, I'll bring it up for them because it's on the internet. You can find it. And you look at it, it says, oh, they said that they can engage in tactical asset allocation. Well, that's market timing. They can engage in fundamental analysis. That's stock picking. And you just, well, did you realize that the investment manager was doing that? Had no idea. And you read the prospectuses of the investment portfolios and actually see that they'll say, hey, we're looking for undervalued companies. We're looking for overvalued companies, those types of things. So that is the problem that you run into. That was one topic of conversation. Another thing that they jumped into is one of my favorites because it's one of those things that is sneaking into portfolios more and more these days. And this is the whole private equity thing. It is something that Wall Street, it's one of the things that Wall Street just loves because they're selling the daylights out of this. It gives them something else to sell. And quite often, the investment advisors aren't really they're not that knowledgeable about it, unfortunately. I remember back years ago when we were, I was working for an investment firm and we had limited partnerships. I didn't know any better. But, I didn't sell them because I was just, my personality is if I don't get it completely, I'm not talking about it. I just can't. I can't stand the idea. Maybe it's I can't stand the idea of finding out that I was dead wrong about something and I just couldn't do it. But, they would talk about limited partnerships. They would talk about that they had these the oil and gas limited partnerships was one of the things that we had. We had tax. There were tax. I'm trying to remember what they were called. But we would have low-income housing credits. That's what it was. It was tax credit investments. Now I remember what it was. And it sounded good on paper. I mean, man, it sounded really good. Some of the real estate investment trusts. And that was something that I saw sold like crazy throughout the year still. From time to time I see them. And you can get in and then all of a sudden they say, hey, you're going to give you this 7-8% return. And then all of a sudden the return dries up and you're sitting there with this thing that you can't get rid of and there's no market for. Well, it's the same thing in private equity. This is what's been happening in private equity is people get in and then they can't get out. And that has been all the news. Well, that was one of the topics of conversation. And here's what they had to say.
So recently, this is it, David, launched a first of its kind private markets SMA solution with Partners Group to enable greater retail access to private equity and private credit.
Yeah.
How do we feel?
Greater retail access. In other words, we're going to let the general public in on this great investment. We can't wait to let you lose money too. We just can't stand the idea that it's just the rich people losing money on this stuff. We got to make sure that you're losing it too.
BlackRock has been very active there. Obviously, they bought each.
Well, how's that working so far?
Yeah, exactly. How's that working so far? I love that question. That's really pretty funny. How's that working so far? Yeah,
well,
BlackRock.
I mean, the real question I think will be: listen, we've been focused on private credit for some time in terms of liquidity issues that many of the funds may have.
Yeah, you can get in all day long, but just try to get your money back out of that thing.
Because they may get redemptions in excess of what they can return in any given quarter, which highlights the illiquidity of the product, which it's designed as.
What? It's designed as. Now, listen where he's going here. It's designed as private credit. Now, I was talking about bonds in a portfolio. What are bonds there for? They're there for stability. It's there for something that goes up in value when stock markets go down. So, not if stock markets go down, markets go up and they go down. I've got to have something that is liquid that I can pull money out of to buy stocks when I rebalance my portfolio, or if I'm taking income, I've got to have something that I can get money out of that hasn't gone down in value with the stock market. Now, what's he saying here? He's saying that it was designed to be a long-term thing. Let me go back.
Which highlights the illiquidity of the product, which it's designed as.
Again, designed as not what?
But it raises the question for these products that are delivered to the retail investor or the 401k.
It won't work in the investment portfolio is the point. If I have something that goes down in value and or it's illiquid, I can't rebalance my portfolio with it because I can't get my money out of it to buy the stocks.
Investors to whether they are appropriate. Now, many would say, I'm Mark Rowan from Apollo, would say 401k, you're saving for your retirement. You should absolutely have this ability to grow your assets, perhaps at a higher level.
Whoa. What's he saying? This is money for your 401k in private credit so that it will grow at a higher rate? What's that based on? What's it based on that you'll get a higher rate of return on it? Is it possibly based on the idea that before these companies didn't have access to a lot of money, and because they didn't have access to a lot of money, they had to pay more for it? That risk and return type of thing. There was a study done years ago about illiquid investments having a higher rate of return. It's interesting. It's a really interesting study. And the funny thing was by an academic that, I really respected a lot of his research. I won't name him, but I respected a lot of his research. But when he came out with that, and he says, we need to invest in this because of the illiquidity gives me higher rate of returns, I shook my head and I was like, no, thank you. Because the problem that you run into, there was a risk return type of an issue going on here where there's all of a sudden they had more liquidity. What would happen to the return? If the higher return was due to the fact that there was no liquidity, if all of a sudden there was liquidity that was entered into the equation, the return would go away. And guess what happened? Yeah, you guessed it. The return went away. It wasn't so great going forward. That's the same problem here. If all of a sudden now you've opened up private equity and private credit to a ton of money in 401ks, now that liquidity premium has basically dried up because now they have access to lots of money. They don't have to pay for it. That's the idea.
Than you otherwise would. Yeah, you're not going to be getting daily liquidity. Why would you need it for a 401k?
You would need it for rebalancing the portfolio, maybe. I need to be on the set with him, just yelling at him.
By the way, it has 11% return the last 4 years. But then we go with Lloyd Blankfein, who wrote a book, Streetwise, and he says this is inappropriate for individuals.
Yes.
And definitely because the individual doesn't really understand the problem.
I agree with that.
Well, I think we've kind of hit it all.
Yeah, I agree with that. Inappropriate. If you don't get what on earth they're doing and you don't understand the game behind it, it may not be something you want to be touching with a 10-foot pole. And the reality of this stuff can be illiquid and you don't have information. You don't know what you're investing in because it's private, as I've talked about so many times. I mean, there's certain things that over the years I've just been absolutely adamant that you get, and this is one of the things that's around right now. Remember back real estate investment trusts when they were so hot, I was like, guys, watch it. Remember when real estate was taking off in the early 2000s, I was like, watch it. Remember when stock markets went down, people are getting all worried about that. I said, watch out. Don't get overly excited about this whole thing when people are talking about abandoning stock markets. Or, when people were talking about the Iraqi dinar, they're always getting all these emails. Oh, what about this? And I was like, oh man, it just never seems to end. That there's always something new out there to get you excited about that ends up being just absolutely abysmally bad for investors. But Wall Street makes boatloads of money trying to sell you things that just really And it's just, typically it's just, they'll come out with all kinds of stuff, equally weighted index funds. And I would go, oh, good grief, watch out. They have, and I would complain that, the index funds, the way they're put together can be really problematic because they're overweighting big companies. And then they say, oh yeah, that's right. After small caps do well, they come out with these equally weighted index funds and they say, hey, this will have higher return. Look at what it did over the past 5-10 years because it weights the companies equally. If I have 1/500th of my money in this company, 1/500th of my money in this company, and I would go, well, what does it cost to manage that thing? If you're having to keep the weighting equal, what are the trading costs that you don't see in the management fee? I mean, it's huge. And, then of course, large U.S. stocks outperform small for quite a while, and they dry up. They disappear. Nobody talks about them. And then all of a sudden, large U.S. stocks come down again. And now what are we hearing again about? Equally weighted index. Dogs of the Dow. In the late 90s, people are talking about this all over the place. The dogs of the Dow. You need to own the dogs of the Dow. And I was just going, it's just a value strategy. Don't get excited about it. And then, of course, it doesn't do so well and then disappears. And then, of course, and this is what happens over and over and over again. Investors get whipsawed because of the sales pitches of the day. They get pulled from one thing to another when the reality of it is, changing around all the time, it just benefits one group of people, the investing world. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here. This is the Investor Coaching Show. Paul Winkler. And during the break, I was reading another article. It was in the Wall Street Journal, and it was talking about turning Trump accounts into multi-million-dollar tax-free nest eggs. And I'm just still kind of hanging, making sure that this is going to be the case. They're talking about setting up an account. This person's talking about setting up an account in July, and amassing money for kids. Talking about if you set up accounts for children and contribute in July, employers and charities can contribute. They're saying here, children born from 2025 through 2028 eligible for a $1,000 contribution from the federal government. That's what made all the news. And, a lot of people, with kids already here, they're too old for the $1,000 and they might not be able to do that, but they should qualify, they're saying, for a $250 per child donation pledged by billionaire Michael Dell, who's throwing money at. They've been seeing a lot of press about that. You got to sign up for this stuff, and this is just it. So definitely worth checking out. You got a few months before it's going to happen, but one of the things that we've been thinking about is, does this make sense? And the more and more that when they're talking about being able to convert this, it's supposed to be treated. What they're saying right now, I'm just going to say this. They are saying that in the year that the child turns 18, the account starts following tax rules for individual retirement accounts. And if you have withdrawals for accounts with no contributions beyond the $1,000 would be fully taxable at that point in time. Some people are saying that you could end up with a kiddie tax. You might want to wait till age 24. when the account balance would be higher, and don't convert it right away because you could have kiddie tax dollars. I'm still waiting till it's just definite. I know exactly what's going to be happening, and I just want to make sure that the tax rules are in stone before I really get excited about it. And I know we got a couple of months before it happens, so I really haven't come out with an official position on that. But I will just say, if we have a situation where it can be turned into a Roth IRA, and you can diversify it, and even if you couldn't diversify it, and you got free money from the federal government, and you could turn it into a Roth IRA, I'm not a huge fan of government giving away a lot of money, but if you get younger people just where the small account, and I've said this before, where younger people, you get them to buy into a stock, just not for the investment aspect of buying into a stock, but just for the aspect of just getting how the stock market works, how investments work. What is a stock? What is a bond? I think, people say, hey, I think that they ought to teach this stuff more in school. I've had that, people say that all the time. I think they ought to be teaching this stuff more in school. Well, there are studies that have been done regarding teaching personal finance to younger people. And while it's good, I'd say it's a decent idea to be teaching kids. A lot of times because they can't apply it right away, they forget it. So I think that there's probably something to it, maybe holding off a little bit later, waiting until they're closer to graduation. Certainly in colleges, I've seen colleges, particularly I do a lot of work at Trevecca, and I'll be pulled in quite often to teach investing classes. There'll be but it's part of a personal finance class, and they're teaching about investing, but also about getting out of debt, managing your finances, saving up for various things, and where to save and how to do that, and how to manage the finances. And I think it's really good at college, especially because now you're getting closer and closer to that point in time when you're actually going to be using the information. You got to watch it if you teach the information too early, because then kids forget this stuff and they don't remember. And there was something I saw the other day that they said that they were going to stop teaching economics, and they were going to teach personal finance instead. And I really, my response to that, when they said, we're not going to teach economics to high schoolers anymore, I don't remember where that was, but my first response was, I don't think that's such a great idea, because too many people think that socialism and communism work now. I was talking to a guy today. He was funny. He's a construction guy. He's a really sharp guy. I mean, this guy, I've known him forever. He's super, super sharp guy. And we got into a conversation, and he just talked about, you ever seen those satellite images? And I said, yeah. He said, have you ever seen the one where the North Korea and South Korea? And I said, oh yeah, I know exactly where you're going. And he says, isn't it something? And I said, yeah, it is. Because if you look at the satellite images of North and South Korea, you see South Korea all lit up, at night. North Korea is dark. And you look at the communist and socialist nations around the world and the darkness, and you go, wow, there is a pretty stark difference between countries that practice socialism, communism versus capitalism. And we started talking about Milton Friedman. I mean, he said, I love Milton Friedman. I said, oh yeah. He would talk about the pencil. And I said, yep, I remember that video too. If you've never watched Milton Friedman talk about the pencil, it is absolutely worth going on YouTube and looking at what he has to say about that. He talks about basically these countries around the world, and they all make different things. Companies that in different areas around the world, companies that, maybe it's rubber. Another place that makes the metal that holds the rubber at the end of the pencil. And then who makes the wood? Who makes the paint for the pencil? Who makes the lead for the pencil? And, you look at how a pencil comes together and all of the disparate groups that have to come together to make this thing a reality. And it's pretty amazing. And that's just a simple pencil. And then you watch him on Phil Donahue, And Phil Donahue is saying, it's greed. He's just talking about greed. And he has this hang up about greed. And Milton Friedman's like, and you're not greedy? You're telling me that some dictator in this country isn't greedy? And he just makes the point that everybody has it. And then the idea behind capitalism is everybody has self-interest going for them. And it may be kind of ugly in a way that everybody else has self-interest, but in order to get what you want, somebody else has to get what they want. You have to serve their interest is the idea. And you have to be others-centered. If I'm going to succeed, and now are there capitalists, is there crony capitalism? Are there times when it is practiced not necessarily that optimally? Yes, no question about it. But the reality of it is, it's the best thing we got. And, you look at what happens when you invest in the stock market. You're able to actually fund these companies that have to be others-centered in order to get business. Case in point, look at what happened this week, or this past couple of months. I saw something, I can't remember, did I even save that article? I probably didn't. But it was interesting to me. Microsoft. They were talking about Microsoft. I don't know where it is. Yeah, I probably wouldn't be able to find it that fast. But it was talking about Microsoft stock, their stock prices, and how terribly Microsoft has done recently. And they were saying, well, why? Why has it been such a rough ride for Microsoft recently? And the reason had to do with how they handled AI. You make a misstep, and you don't necessarily handle it in the best way, and you lose business, and your stock price goes down. You've got to fix it. You got to do something because you're not serving the public, and that's the risk of business. That's why we don't invest in just one company. In fact, I used to use that years and years ago. I would talk about the Dow Jones Industrial Average. And I said, how many companies in the Dow? And people say, well, I don't know. And I would say, well, there are 30. When it first started, there were 11. And you look at, it got changed to 30 companies in 28, 29, something like that, 1928, 29. So what happened is that you now have 30 companies, which were the most important companies of their time. 30 companies that represented the American economy. And my point was, how many of those companies are still in the Dow? Now, back when I first started teaching this workshop on investing, there was only one that was left, and that was GE. And GE has since dropped out. So it's not, none of the companies are left. And the point that I made was, I said, can you imagine? And I named the companies that were in there, the companies that, that made up the Dow Jones Industrial Average. And I would just name off the companies. And I said, do you recognize any of them? And the people are like, no, I don't know who any of these companies are. Victor Talking Machine, stuff like that. And then what I would do is say, okay, now we have a situation where you could have in the future people saying, Grandma, Grandpa, who's Microsoft? And you go, can you even imagine that? And I was like, wow, it was just interesting to see how much their stock had gone down. Not that they're going away by any stretch of the imagination anytime real soon, but that's just a reality. That's why we diversify. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.